We're so excited to have everyone here today with us. This is going to be, like I said, the first of these series. We are going to be doing these almost every other week, and we're trying to aim for Thursdays. So we'll make sure to keep you posted on everything. I'm LaDonna Lockard. I'm CEO of MaxClass. I'm on the road at the moment, so forgive the crazy wallpaper behind me. I had to find the quietest space I could find. But we're so happy to have everyone here. I want to go ahead and just let everyone know because we are getting ready to launch a compliance chapter of our company. This is what this is leading into, but what we want to do in an initiative of both mine and Jeana's has long been we love providing value. We want to provide value to you, and we want to do it just because we want to make this industry better. So you don't have to be a student of ours. You don't have to come back to us for anything. We just want you here so that you can be better at what you do. Well, with that, I'm going to go ahead and get us started. I'm going to introduce Jeana Lanktree. Jeana, thank you so much for being here. Jeana is our Director of Training and Compliance, and she is genuinely one of the most brilliant minds within this industry that I have ever known. She is fabulous at what she does. So, Jeana, thank you so much for being here.
Thank you so much. I'm excited and I can't wait we have so many topics in this industry that are complex and they're confusing and they contradict each other. So just getting things out so that we can understand them in a simplified, arena and ask questions. And as we go through this webinar, we're probably going to have some things that come up that you may have additional questions on. Put them in the chat or send them over, and we would love to do like a follow-up video on those or get you guys some information that you may need. I think it's a lot of fun to see what's out there and what you guys are experiencing and see if we can become a resource and help for you.
Definitely. And forgive me, I am also the host of this, so I'm admitting people as we go. But I want to go ahead, let's get started. I want to be mindful of people's time. So, Jeana, talk to me about the most common LO comp mistakes that you're seeing right now with mortgage professionals and why these errors often go unnoticed until they've already cost people thousands of dollars.
Yeah, there's several. I mean, it's not isolated to one, but two of the biggest we'll kind of focus on. One of the biggest is just not understanding their contract, not realizing what they're signing. And if you're a broker, not understanding what you're building when you're building that LO comp agreement. So really getting clear on what those comp agreements are, what they mean, simplify them. Oftentimes we were talking about this a couple of days ago. We have attorneys that'll come in and there's some great ones out there. So definitely don't want to diminish any attorneys. There's some great LO comp attorneys out there, but they will not always understand your vision. They won't always understand your model. And so they may build a comp plan that you can't manage in the sense of, say they have different, parameters in there and you don't have a system to measure those items to adjust comp as performance adjusts or things like that. So you just want to be mindful of what your model is. You want to make sure that your comp plans reflect that model. And if you are an LO on a comp plan for a broker or a lender of any other type, you want to make sure that you fully understand that comp plan, particularly your exit. So let's be honest, we would love to think that every relationship lasts forever and that we're going to be here and it's our home and, we're never changing our license again. Historically, this industry moves licenses quite a bit and we change homes often. And so as we change those locations, you really want to make sure that you understand the exit clause in your contract, what loans you will be paid on, what loans you won't be paid on, what you're responsible for, and what you're not responsible for. I see people lose a lot of money in that and get blindsided when they're exiting a company and going to another.
I think that's a really great emphasis to make because you're right. It's like a marriage. People don't go into their marriage thinking that they're going to get divorced, but taking that time on the front end to really prepare and look at what that exit strategy may look like, how your comp may be structured for loans that are still in the pipeline. That's a big area that I've seen a lot of people get hung up on is they assumed that because they had done so much work on a loan that they would get paid out on it because it was so close to closing by the time that they left, or maybe it was even 30 days out. And then next thing you know, you have both the broker and the LO, and they're fighting back and forth as to who should actually get paid over it. When if it's in the comp plan, it's there, it's in
Ex-
writing, you know what you're working with.
Yeah, and oftentimes, I mean, they may have to move those loans to another LO's name or someone else that's carrying that license to close them out, and then they're dual comping. So you just want to make sure that that's outlined. It's very clear, particularly if you have a sign-on bonus. Let's be honest, these exist. They're not everywhere, but they do exist. And what that looks like in an exit and how much has to be paid back and what you're left with is huge. One of the things that I saw somebody get a really big surprise on was they didn't get compensated on the loans that they had left behind, yet they were fully responsible for paying back their bonus, and they wanted that amount deducted from the bonus, the sign-on bonus that they had received. So there, it can get very muddy. The clearer your contract is, the more specific it is in outlining those particular items, the better off you're going to be overall.
I want to go ahead and shift gears just a little bit. Let's talk about clawbacks because they've become increasingly a hot topic. They're on so many people's minds within the industry, and they're being done incorrectly. They're being implemented incorrectly. What to you triggers a clawback situation, and what should loan officers know up front to protect themselves before the deal even closes?
This is a big one and it is a hot topic. So brace yourself because I will be transparent, right? What the rules say doesn't always mean that's how it's applied in application out on the
Mhm.
street, right? So let's be real about this. I think that's one of the things we do is we just stay transparent and honest. So according to TRID and according to Reg Z, a clawback can only happen in an EPO, right? So if there's an early payoff, meaning that the client has refinanced or they have paid off that loan prior to the initial 6 payments being made, then they can go back and recoup all of the commissions as well as potentially any additional fees for that loan. That's in essence what they say. However, you have, Dodd-Frank and these other ones that are going, wait a minute, there's some parameters around quality and there's parameters around long-term performance. And those technically could be a clawback as well if you have an LO that is consistently, their loans aren't performing long-term or their quality is poor. Here's what I would say about that. And, we're not here to tell you how to run your business. We're definitely just sharing insight and you can do with it what you want. Most of the time, here's the issue with that, and one of the things that you just need to be mindful of. First off, the term quality is very vague. So you're
Mm.
going to want to definitely define what quality means in your organization and whether you're going to be compensating that in a bonus or an additional compensation plan, right? Where maybe it's reviewed every couple months or something like that. And then if your quality is at a certain standard and it meets certain criteria, you get additional compensation. The other option is, if you have long-term performance and your loans consistently are performing at a level that is satisfactory to your particular lender, then you can have additional compensation. This is one of those areas where we will see lenders come in and determine, hey, instead of doing a bonus on this, we're going to assume that the quality is there. We're going to make the assumption that long-term performance is intact. And so we're going to initially pay higher compensation. However, if we determine quality has diminished or long-term performance has diminished, we're going to come back and do a clawback on that compensation. Here's the challenge with that. Oftentimes, quality is not identified and the measurement system is not in place. So let's just give an example if you're a broker. If you're an average broker out there, you're sending your loans to several different lenders on a regular basis. The more volume you have, the more loan officers you have, the broader use of different lenders you may experience. And so measuring long-term performance becomes harder. You also have, quality. When you're going out to several different lenders, how are you measuring quality? The internal quality of their underwriters, processors, or whatever systems you're using internally at those lenders can vary drastically. So having that as a clawback, it's not a bad thing. It just has to be written extremely well. And you're going to want to make sure that your particular broker, your lender, whomever you license with, has that outlined very clearly for you. And if you are the broker or the lender, you want to make sure that that is outlined really clear in your contracts. I'm a big proponent of rewarding good behavior, like rewarding positive behavior. So personally, I like to see it more in an incentive bonus, like, hey, you performed outstanding quality. And so every quarter we measure this. That's another caveat that you want to make sure you're watching. How often are you measuring this? And let's be realistic. Let's ask the honest question. If you're a small broker shop, who's going to be measuring this? How often are you going to be pulling a report to measure this? And how often are you going to be in sync with your lenders to determine what quality is? And do you trust their judgment? So there's a lot of caveats in that. Going that route doesn't mean it's wrong. It just means that it has to be managed entirely differently. And if you don't have somebody to manage it appropriately, write it appropriately, you could end up in hot water when you try to do a clawback on an LO that isn't happy about having their money taken back.
Do you have advice for the LOs and the brokers and potentially the lenders on here who are wondering what the best way is to structure this based on quality? What does that kind of look like to you? What would a quality file that deserves to be rewarded, that extra compensation, look like to you?
Yeah, I think that's a great question. So one of those, a lot of lenders are measuring the pull through rate, right? When you're
Mm.
locking, what percentage are you actually closing of those loans once you lock? Another measurement could be how many conditions. Now, granted, depending on the underwriter's quality, that might not be a great measurement, but you could look at, quality of conditions. You can look at how many times you've had to flip that loan, right? If you see a loan officer, LaDonna, this is almost embarrassing, but I had a processor of mine reach out just this week, and there was a loan that went into the pipeline, no joke, close to 6 months ago. And this loan has been reworked and reworked and reworked. It came in, it did not qualify. This client has been put through the ringer. And she sent me a message and she says, we finally closed this loan for these clients. I mean, we're nearly 6 months out, and those clients, I guarantee you, did not have a good experience. So you could look at, client reviews as one of the options, but predominantly, how many times are you restructuring? Is that loan going into underwriting and coming out with the same expectation and closing? I think turn times are another great measurement. If you have, loans that you're locking on a certain day, how many times are you extending? That tells me that you're not managing that pipeline well. And if you can't document that it's a client induced issue, a reason that you're extending, that could potentially become an item or a hot topic if you're in an audit and LO comp is being reviewed.
Great, fantastic answer. And again, for anyone who has recently joined, I'm LaDonna Lockard, CEO of MaxClass. Forgive me, I am on the road. So if you're wondering who all these random people are walking by, that's what's going on. But again, we're happy to have you here. And I know we've had quite a few people come in late. Jeana already has shared a lot of really fantastic information. We will make this recording available to you so that you can go back and catch the beginning part of it. Now, when it comes to structuring LO comp plans, what do you think are the red flags that brokers and branch managers should be watching out for, both from a compliance standpoint and a profitability standpoint? Because let's be honest, both of those things, they don't always work tangentially. So, what would you say would be the two kind of words of advice on that?
Yeah, I think this is actually a really good topic as well, because the first red flag is a lack of clarity. If there's vague verbiage, right? We just talked about the example of quality, or if there's verbiage that is not really specific, you may have a flat comp, but you don't outline what happens in HELOCs. So, HELOCs are a good example where sometimes they're a flat fee or sometimes they're a borrower comped only type of loan. And if you don't have verbiage specifying how you're going to handle HELOCs, that could potentially result in some lack of profitability. So those items you want to make sure that you're outlining. So the more specific, the better, but don't overcomplicate it. You don't have to have a dozen different lines, and it doesn't have to be a maze that people have to figure out. Less is best, and simplify it. Look at your model, go, hey, what do we actually do here? And then outline those particular items and put what the comp should be on those. It's not as complicated as we try to make it, but we hear all these different things come out, or we see these big comp plans from some of these bigger lenders, and we're like, oh man, this doesn't look like this. We need all these additional verbiage. But the reality is it's making it difficult for you. It's making it difficult for your LOs as well. So you just want to make sure that the least amount of vague or generalized verbiage possible. You want very specific terminology in that comp plan when it comes to what pays out on what types of loans. And obviously we can't go into steering or anything like that, but what I'm talking about is borrower paid, lender paid, HELOC, things like that. So you want to be extremely specific. The other big red flag is deviating from the comp plan. This is something I see often. And
Mm.
I'll give an example where, if there's oftentimes that you may have to go in the non-broker space and you're getting a pricing exception. And so you're going, hey, I need a pricing exception. And you don't have pricing exceptions outlined in your comp agreement. You're approved for that pricing exception. However, there's no way for them to, your lender or your branch manager to recover those funds. And so I've seen them get really creative and deviate from the comp plan entirely and go, okay, well, we're going to only pay you X amount on this loan. Or, all right, that's fine. I'm going to let you have this PE, but I'm going to pull this back from your marketing account or from your reserve account. And so oftentimes some of these lenders will create a marketing account or a PE, or some type of reserve account for the brokerage or for the lender, and a certain amount of your loans will go into those, a dollar amount will go into those accounts, and then they pull back. It's essentially a clawback, but it's for a PE that's not outlined, and it doesn't technically qualify as a clawback. So it's definitely in the red zone. So you just want to make sure, very specific, outlined clearly, and don't deviate on verbal agreements outside your comp agreement.
We did a Take It to the Max yesterday, which is my podcast. It actually literally just dropped. The notification came up as I brought this up. So, what timing is that? But we get into EloComp a little bit more on that. And one of the things that I brought up is I've been doing this now for about 15 years. In the previous company that I was with, I actually helped to start up their compliance department. One of the things that we did was put together companies' LO comp plans. And I cannot tell you how many times it happened to us where we would have someone bring us a plan that they had paid $20,000 for an attorney to write for them, that allegedly was an LO comp expert, that went through, and it was like again, God bless attorneys for doing the jobs that they do, but there's kind of a justification for doing their job in the contracts that they're providing to you. And so sometimes we would see these plans that were just so nuanced and so unapplicable. What would you recommend to someone who maybe has had an attorney put a plan together for them, that in reviewing it, they're like, well, maybe this doesn't fit us? What would your recommendation be?
Yeah, first off, if you don't understand it, neither does your team. So that's
Hmm.
just, if you don't get it, neither does your team. You can't expect them to understand something that you yourself have questions on. And then you got to look who's going to enforce this, right? So first off, when you are, if you are in that situation where you already have one, and I get a lot of calls on this, we had a gentleman that called and said, hey, look at my comp plans. They had given ownership shares to dozens of realtors, and they were having to issue K1s, and it became an accounting nightmare at the end of the year, and it wasn't fruitful. So we had to make some tough decisions on how do we completely restructure this, or do you start it over? Like, how bad, how deep does this rabbit hole go? So it depends on the depth, how long you've been in it, what your comp plan is actually um, has outlined in it. But I would start with the basics. First off, can you understand it? Do you understand it in totality? If you don't, you likely don't have a comp plan that's aligned well with your organization. Secondly, look at the basics. So I would start with, what is the comp outline for just LO comp? Like, how are we paying our LOs for the loans they're doing? Are we paying them on tiers? Are we paying them on flat fee? Are we paying them percentages? Do we have variations? So look at that and get really granular with that piece. And now look at all the stuff outside of that. And if all of that extra stuff applies or does not apply, then I would start removing that. And I would get with somebody that, maybe not the same attorney that wrote it, because they're going to be very passionate about what they wrote, unless you have a great relationship with them and you can go back and say, hey, look, got this thing. But get with someone else in the industry that has been in owned in the space that you're in, right? And they've been in it longer, or they have more experience. They generally have a lot of resources that they can give you. You can also compare comp plans with friends. The one thing I love about this industry is how much we're sharing right now. People are really collaborating, they're sharing. So ask somebody that's doing it better than you and say, hey, can you walk me through this? What are your thoughts on this? And you're likely going to start getting some insight in what direction to take. But it's never too late to change course. It's never too late to turn around and look at something and go, all right, we've got to rebuild this, and see who they're using. They may have a great attorney or they may have a great resource that builds those. Also, a lot of your lenders have a ton of resources. So get with some of your larger lenders. They're going to have some great resources and they'll be able to help path you into getting better comp plans. But simplify them. These things don't need to be, dozens of pages. I've seen plenty of successful ones. In fact, some of the most successful ones that are just, 2, 3 pages long.
I agree. I think the simpler, the more concise, the better. But usually that's the take that I like to take when it comes to compliance. I don't want a ton of legal jargon in there because the majority of people reading them aren't attorneys. So let's make them as simplified as possible. I do want to follow that up with one more quick point. I think that is a misconception that a lot of people have is that once a comp plan is in place, they can't change it or that they can only change it once a year. If I remember correctly, I want to say it's quarterly. Correct me if I'm wrong. Is that right?
This is interesting. This gets brought up in class a lot. The reality is you can change a comp plan whenever you want. So
Oh,
here's the thing. Our lenders are going to shoot me emails about this. They're going to be like, I'm going to get hater mail. Here's the reality. Can you imagine the lenders getting asked to update comp plans every day? So there is no time limit on when you can update a comp change or not. However, the lenders have created, majority of lenders have created their own overlay on this. And they say, hey, quarterly, we're willing to update, because they don't want LOs going to them or brokers going to them and updating comp plans on a daily basis or weekly basis. Because let's be honest, we are an industry that tends to be a little messy and we make a lot of changes, and we may have one loan that we like this comp on, and then that lender would get a request because we got another loan that we need to readjust comp to make that one work. So the lenders have done this to protect themselves. It's a smart move. And so industry standard is 3 months based off of lender preference, but it technically can be changed at any point in time.
thank you for that clarification. I do think, too, if you are changing it and when in doubt, document it out. Anyone who's attended our classes has heard me say that. Make sure that you're keeping documentation as to why your comp plans are changing, particularly if they're changing maybe just for one individual or a couple of individuals. So I think that that's a great distinction to make.
And
Let's
LaDonna,
go
that goes
ahead.
back to the
Yeah.
clawbacks too. So, a lot of
Yeah.
times people are afraid to change comp agreements. But if you look at, the reason we're going into clawbacks, rather than doing that, if you're pulling historical data and you're comparing, I don't like comparing one person to another, but I like comparing averages. So I'll say, hey, the average branch is producing this level of quality and this level of performance. Your standard of quality and performance is measured at this amount. Because of that, we've assumed that you were doing X, Y, and Z, and this is why you get higher comp. We need to adjust the compensation to, make up for that difference. So sometimes a comp plan adjustment is the better way to go versus a clawback for performance or quality.
Thank you so much for that. Regulatory scrutiny around LOComp rules under Truth in Lending and under Dodd-Frank really hasn't slowed down, even though we're kind of seeing that shift within the regulatory sphere. How do you feel like mortgage professionals being audited with their current comp plans what should they do so that they're not inadvertently stepping into legal exposure?
Yeah, I think it goes back to everything we've been talking about, right? The more clear, the better. Clarity is kindness. We always say clarity is kindness, but definitely make sure that those are really clear. The other thing we're seeing, and a lot of things that people are sharing in class as well, is these audits, a lot of people are licensed in multiple states. And so as far as the big regulatory, those guys have their own challenges right now. And I think the best thing we can do is work with what we have at the moment. We can get caught up in a lot of noise. There's a lot of noise right now. This industry loves a lot of noise, and there's a lot of speculation, what will happen, what won't happen. And you can get stuck in that. You can get really fearful. What you can do is work with what you know now and today. What are the rules? What are the guidelines today? And what does it say? What are the rulings as of right now? So operate in that environment. Make sure you document everything as clearly as you possibly can. Keep things fair. I see so much bias when somebody is a higher producer and they don't want to lose that name, might not even be profitable, but they like that name attached to their brand. And so they give a lot of leeway. If you go into an audit position, you're going to have to document why, LOA received this, special treatment. LOB did not receive the same. So make sure you're staying as consistent as possible. And then when it comes to your audits, just know that every state varies. So
Mhm.
the more consistent you are, the more even keeled and the more standardized your operations, your systems, and your processes are, the better you'll fare in whatever audit you're in. Because if one state, I had a gentleman, he told me, he said, Jeana, I got state X telling me they want X, Y, and Z. I've got, this other state telling me they want this and this. And because he was able to show that he does everything the same every single time, and obviously makes the adjustment for those certain state additional regulations, he ended up just fine. But it does depend on who's auditing you, and every state does vary. So consistency is key right now. Keep your ducks in a row. Make sure that you're keeping everything as, I don't like the word fair, but standardized. So keep everything as standardized as possible and documented well, and you should fare fairly decent in any type of audit. But also make sure very, very clear verbiage, and don't do verbal agreements outside of the comp plan. So if they see a deposit going out of the bank into an LO's account and it doesn't match a comp plan tied to that specific loan, you're going to come under scrutiny. So, follow your comp plans. And if you need to adjust them, adjust them.
Yeah. With LOs who may already be listening right now, who feel like maybe they've lost money due to a comp issue or a clawback issue, what are 2 to 3 concrete steps that they could take in order to assess what's been done and course correct?
Yeah, oftentimes they don't realize it because they're in a hurry, right? Once they have a live loan, they're going, they're not really thinking about that. And we're all guilty of it. We're all guilty of saying, "Hey, I'll look at this in a moment," right? I have one right now that I'm kicking myself on because I did the very same thing. Like, we'll deal with this after, and after left me out quite a few dollars. So it happens even to the best of us. So none of us are immune to it. What you want to do is just make sure that things are lined up early, right? You don't want to figure it out after the fact. If something is unclear during that loan process, get it dialed in before that loan closes. Make sure that everything is lined up. If you're in the middle of a comp plan change, make sure that comp plan change is in effect prior to that loan closing. You don't want it to get stuck in the crosshairs. That is, I see that happen a lot where somebody's in the middle of a change and a loan closes, their name may accidentally be removed from the file, or it may
Mm,
accidentally move to a different space in the file. Now that loan is closed, it's paid for, and there's no way to reconcile it. So just make sure everything is in place prior to those loans closing. That's going to be first and foremost. Two, check your quality. Quality is a big key item in our industry, and a lot of us are trusting other people to do that role. So you might have a loan partner, you might have some other person that's doing some of your day to day, and you're trusting them implicitly. Or if you're not trusting them, you're not following up and double checking their work. I get it. It happens. It's part of our industry, but we really do have to start doing a better job of making sure that the people that are sitting in the seats representing us are upholding the standard that we have for our business.
agreed. Agreed. In your experience, are there specific types of LO comp plans that, whether they're flat fee or they're basis points or they're tiered models, that you feel like create more of a clawback exposure? Um, and why?
Good question. LaDonna, you got good questions today.
Thank
Great
you.
questions. Um, I got to tiptoe on this one a little bit, right? I don't want to call out one particular comp plan. What I will say is do your diligence. I had a friend that recruited over, and she came over. She was so excited, and she was like, she was a large producer, and she was going into a P&L model. She was really excited. She was going to have full autonomy, run her own thing. And she got her first P&L and saw the payroll taxes. She came over with a big team, and she wasn't prepared for payroll taxes. It threw her off her rocker. And as she dove deeper into her P&L, she realized that in this particular case, it doesn't mean it always is this way, but she had a lot more exposure. And so because of all that exposure, her comp was not as determinant as it was when she was just a flat percentage LO. So she got into this world, realized it was very different. She didn't want to manage a P&L. It got really messy for her, and she ended up losing quite a bit of money. So in that particular case, it didn't pan out very well for her. We see a lot of these flat fee lenders that are coming out, and I think they're great. They have an advantage. They have some really good like pros to them. However, you also want to check out the cons. What are you going to be responsible for? Are you responsible for credit? Are you responsible for your LOS system? Are you responsible? So look at the things you're responsible for. Make sure that you understand those things and what could they potentially come back for. So have those conversations early. Make sure that you're doing your full diligence. Don't assume, I have somebody that called and said, I'm going over to here, they're paying X amount, for loans, and I'm not going to make that anywhere else. And I just talked to a loan officer at that very same place, and that loan officer had said, yeah, they advertise this, but my actual take home right now is 40 bips. But I've got great pricing. And so 40 bips of, 10 times more volume is working for me because XYZ. So I don't want to preach that one model is better than another. What I do want to say is know yourself, know what your model is, know what you want to design in this business, and then align yourself with the right model that fits that. And if you don't have clarity on that model, ask people that are already there. Ask people that are already in that space. Don't be afraid to pick up the phone and go, hey, I know that you're a loan officer at such and such. What's been your experience? People are more than willing to share. I've been really inspired to see how willing people are to share in this industry. It's refreshing. It's refreshing, and it's a nice change.
No, I agree. And I think a lot of people don't completely take advantage of that and the fact that we are all in this together. So why not pick other people's brains within the industry, make those friends, make those connections, have those mentors so that when the time comes that you need someone to turn to, you have a trusted voice and a few of them.
Mhm.
Speaking of trusted voices, for new LOs who are entering, or maybe they're shifting companies, what red flags would you tell them to immediately look out for on a comp plan? And what do you think constitutes the right comp plan for an LO?
Yeah, I think about new LOs coming into this industry a lot because let's be real, this is an industry where people come in and they're like, show me the money. I'm getting rich. I'm getting rich. I'm going to be an LO, right? At some point, there was, this lure of that. And we are here to help people, but they get, the shiny bright lights in front of them. It's, the sparkly item in front of them, that the dangling carrot. And so with that, you want to make sure, as they're coming in, that they understand what their role is going to be. Oftentimes I'll see people guaranteed leads, and they'll go, hey, you're going to come in, you're going to sit here, and they end up as pretty much a call center person. They're earning very minimal comp on what they're actually, bringing in. And then if they have their own comp, they aren't allowed to put that loan in their name, and it has to go to the branch leaders. So there's a lot of different models. I'm not going to knock models, but what I will say is just be very clear on what you're getting into, because they might not have the book of business. Obviously, if they're just getting in this business, they're not going to. And so maybe they need to start in a seat like that so that they can really learn the ropes. And that would not be a bad thing. That would be a great thing for them. They could get a lot of experience. They could start learning what it takes to be an LO, and then eventually, start building their own book of business. Where I think there's a big red flag is if they do have the intention of becoming an LO and they get into one of those seats where they're assisting another team with their items or assisting another LO with their items, when that LO doesn't allow them to build their own book of business and they don't allow them to grow under them. And it's that can sometimes be a little, it can hold them back. And the better they get, the harder they're going to realize it is to switch into being an LO, because that LO that has utilized them and raised them up in the industry isn't going to want to let them go. So make sure that these relationships are reciprocal. Make sure that not only is that person serving you in your business, but you also have an agenda to eventually serve them and their business when the time comes. And how you guys set that up will be different for each person, but the conversation should be had early. That's one of the red flags I see. The other red flag is them coming in, becoming an LO immediately, starting to build a book of business and not doing enough research, making a lot of false claims, thinking they can do things on their comp that they cannot, or trying to make a loan work. And one of the biggest things is not understanding the difference between lender paid and borrower paid, or not understanding how to navigate that conversation with a client. So that's a big one. And if any of you are looking to mentor new people coming in the industry, or your person next door in the industry, or just sharing information, whoever can start sharing people how to have that conversation and really make it land simplified for clients, it's a big value add. There's a lot of people that don't know that.
It is an important thing to be able to dial in and nail down and feel confident in when you're presenting. When you look at the year ahead, do you feel like there are any regulatory changes coming about that you're aware of that you feel like may be causing LO comp issues to come?
Well, there's a lot of talk right now about LO comp changes. I mean, it started last year, right? We saw the CFPB come out and say, hey, we're going to look at revising some LO comp rules. A lot of people went and petitioned and said, this is costing the consumer because we don't have the ability to fluctuate our comp to make a loan work. And so we're having to get really creative. When they get creative, it opens risk exposure, and people don't want to be in that space. They also don't want to see their client not get in their home. The reality is the people that form these rules and regulate these things, I do believe they have the best of intentions. I believe that firmly. Unfortunately, they're not the person on the phone that's getting the call that says, little Jimmy wants to be in our house on Christmas Eve because we bought a Christmas tree and now it's in the back of my truck and we can't close because, we don't have enough money, or we don't have this, or whatever the case may be. But, it's the LOs that are actually taking those calls. They're the ones that are going to bump into them in their community and face them at a restaurant, face them somewhere else. And you want to deliver for your client. And as best prepared as we are, and the amount of quality that we put into a file, there are things that come up unforeseen that we just don't know about. And they come up at the last minute. And it is an absolute advantage to be able to say, hey, I'm going to lower my comp to make sure that I can put you into this, oftentimes generated with a lender credit of some sort. We do see that ability in some retail space, but when it comes to the broker world, we're just, handcuffed on that. And so we lose advantage there. And when you look at what the CFPB findings in their annual report that just came out with their budget and everything, the data shows that it does hinder borrowers' ability to get into homes. Some of these rulings are hurting us more than helping us. And compared to what they've cost over what they've recaptured in, fines and regulatory compliance enforcement, there's a large gap. And so what the future is, I don't know, to be honest. I don't know what the future is. None of us do. If somebody has a crystal ball, please tell us. But I will be candid in saying it doesn't look good. It doesn't look good. So I do feel that because it doesn't look good for these regulators and these entities that are in this space right now, it looks a little bit better for us. However, there's a timing issue, and who's actually going to rule on it and enforce it, regulate it, and put it back in place, that's to be determined, the time frame that that's going to take. Change is coming. I do feel that. What the time frame around that is and what that looks like when it finally arrives, that's the part that's to be determined.
Do you happen to have a copy of that CFPB report Joe is asking?
I do. I'm happy to send that
Fabulous.
over. We can provide that. We'll send out the link on it.
Fabulous. That'll be perfect. Hopefully, we can include it with the recording link of this. We are getting close on time, and I want to address this question from Nancy. Nancy basically asked, why did LO Comp come about? I'll speak to it a little bit, and then if you want to elaborate, that's great. But
Yeah,
basically,
great.
after the financial meltdown, Congress took a look and said, hey, wait a second, we need to be doing something. We have too many people who are steering these borrowers into mortgages that they can't actually afford, also that they can get paid. Also, at the time, we were charging YSPs. YSPs were a big part of why LO Comp was implemented. So it really was put into place back in 2011, if I remember correctly. It was an amendment to TILA, and then under Dodd-Frank, it codified it. But it is put there to protect consumers from being overcharged by LOs. If you want to elaborate, please feel free.
Yeah, we also saw a lot of steering, right? So we had back in the day, we could make, say you were doing a VA loan or you were doing an FHA loan, government loans historically pay better, and we would recapture that in our LO comp. And so you could make three, four, some people would make even more than that on a particular loan product. Maybe conventional was the better option for that client. Maybe they had a little bit more to put down, but the LO could make more if they put them in a government program. And so they would steer them into FHA and put them in a government program that had MI and other things that might not have been a benefit to that particular borrower because the LO could make more money. That's essentially it in a nutshell. And so they had to get where our comp was fair, regardless of the type of loan the client was put in or regardless of the terms. You know, sometimes we'd get paid more if there was a longer prepayment penalty. And so the longer that prepayment penalty, the LO would get additional compensation. It's not a benefit to the borrower. It didn't serve the clients. It served the LO and our compensation. So they had to get some regulation around that to make sure that all things considered, we were doing fair and representing loan products to the best of the client's well-being instead of our compensation.
We have another question here from Cleon, and I know Cleon has had this question for a while of how is it that non-licensed people, MLOs is the term he used, but non-licensed people basically are acting as business development reps. How is this possible? I can speak to this a little bit and then I'll let you elaborate if you'd like.
Yeah,
But
Cleon's bringing the heat. This is gonna be a heated question.
I
I'm glad it
know
got asked.
it's a good one to ask. In my experience, the only time that I have seen this really come up is for private lenders and for people who are on that side of the industry. And no one on that side really has to be licensed. It's still the wild, wild west over there. Don't get me wrong. I'd love it if they did. I want all those people coming to MaxClass, but that's been my limited experience of it. Jay, what do you have to say about it?
Yeah, so this is interesting. We see a lot of LOs, and I promise to stay transparent. So I'll probably get more hate mail for this one. We see LOs that lose their license because they're not compliant. Let's be honest, they're not. They lose their license in a certain state, and all of a sudden they become coaches. They start telling everybody else how to do this, or they become business development because business development is now a W-2 role. And what they do is they'll collect some W-2 type of compensation or some type of 1099 contracted compensation, and they'll build groups that they put other LOs or these brand new people coming into the business that can get a license. They'll pay for them to get their license and they'll run loans through them. I see it often. I am not a fan of it. And unfortunately, that's how they get around it. That's how they're navigating it. But I would say to your question earlier, LaDonna, it's a big red flag for somebody coming into the business. I had somebody just did our Austin class, and they were telling me, yeah, I'm going to work with such and such. They're going to, they're this great coach and blah, blah, blah. And the whole time I'm sitting there silently smiling because I happen to know that that particular person lost their license and is now a business development person. So
Perfect.
that's how they get around that.
Perfect. It's tough. I mean, we have like the SAFE Act that is put in place that is supposed to regulate and prevent those types of situations happening. But like we see in the majority of cases, if people want to get around the rules, they'll figure out a way to get around the rules. Now, just because you figure it out, it doesn't mean that a regulator isn't going to come back and say, you got around this rule and now we're going to make an example out of you. So I will always give the most conservative advice. I think that's the best way to go about it when it comes to compliance. But again, we really do want to balance out the real world application of how these things are put into play. We have one final question and then we really should wrap this up. But Gerald asked, how is it that you can work at two different companies at the same time? I can speak to this. And then again, if you want to elaborate, there is a SAFE Act loophole that if the company that your license is hung with is not licensed in a state that you want to be doing business in, you can hang your license also with another company so long as that company is not licensed in the company of your primary license. So that's how people are able to do it. Any
That's
elaboration on it?
No, I mean, I think that's exactly how I would have answered that. That is the case in the fact of licensing. If you're talking about somebody that is solely licensed in one place, but working and representing another place, oftentimes it will fall back to what we were talking about, which is where they'll accept a 1099 contract. They won't actually move their
Bingo.
license there. Or they'll accept a W-2 role where they won't move their license there. Now, I will tell you that initially it sounds like a great idea. However, if the NMLS or if regulators get a hold of this, a lot will come into question. And at that point, they will require you to move your license over to the company that you're representing primarily. So beware, depends on how it's set up and how they're actually representing, if they're in there as a consultant, if they're in there as an actual employee, and what their licensing is, how they're acting in that role will determine that.
I have also seen examples where people will set up a 1099 processing company in order to do it, as well as 1099 underwriting, et cetera, so that technically they're providing a 1099 contracted service, but it can be misrepresented as them working for two different companies. So, perfect example, working on a post-closing desk at one company and an LO at another. Perfect
Yeah,
example of
that's a
that.
good example. And the reality is that if that gets found out, so they will get away with it for a while. But if the company that is licensed, that they're actually working as post closing, they do have to move their license. And you see this a lot, right? You see this a lot. I'll be honest, I tried it myself and had to move my license. It's just the way that it goes. So it is not compliant. They do have to move their license over, because if they are carrying an LO license and working at any lender, they need to move that license over to the lender that they're under.
As we wrap up, I would love to know, do you have any final bits of advice for people who maybe want to go back and look at their LO comp plans now that they have some of this additional context? What would be your final piece of advice for them?
Don't be intimidated. I think that's a big one. We look at those LO comp plans and they're intimidating. I can't tell you how many people they send over that file. You sign it, you docu-sign it, whatever. And you're like, just as long as I know what I'm making on a loan, I'm good. And they don't read all the fine print. So don't be intimidated. Break it down into little sections, get familiar with it, review your LO comp agreement. There's so many times that you may see something that could work to your advantage, or you may see something that you want to renegotiate. I always renegotiate every plan that comes over to me. I'm like, well, can we change this? Can we move this? Can we move that? For instance, one of them, LaDonna, was with us. Like, my comp agreement stated that I couldn't work or represent anybody else as, in any other role. And so we negotiated that. And I said, hey, look, I'm affiliated with MaxClass. This is what I do. And I can't be here if I can't represent MaxClass, because I'm not leaving MaxClass. And so we worked around it. We negotiated it. They rewrote it. And now I'm completely compliant and everything's great there. So you just want to make sure that you're representing yourself. You can't expect anybody to come in and save the day for you or rescue you if you get into hot water. Really be an advocate for yourself. Look at your own comp plans. If they don't make sense, ask questions. And if they still don't make sense, or there's something you're in disalignment with, see if you can renegotiate it or come to terms that are mutually agreeable. This is not all about, LOs making the most comp at the expense of their lender or whoever's housing their license. You want it to be a win-win for both sides. Whoever carries your license, you want them to win because you're there, and you want to win because you're affiliated with them.
Fabulous. Fantastic advice all the way around. We've had a few people who have just joined. Our apologies. We are actually wrapping up. So we will be sending out the recording of this. I do want to also spotlight that we have had continued conversation around LO Comp, both in Max Combos, which is a segment that I do for NMP, National Mortgage Professional. I highly recommend going back, watching that. It's a lot of fun and gives you a better glimpse into both myself and Jeana. But then there was also the Take It to the Max episode that literally dropped today on LO Comp. We covered completely different topics and questions in that podcast episode. Additionally, MaxClass does have an LO Comp course. So we really do want to make sure that you all feel very prepared and aware of the changes that are coming ahead of us in this regulatory year. So, Jeana, thank you again so much for being here, for your knowledge, for your expertise. As one more just quick point of reference for people, the next episode that we will be doing of this series is going to be a date with Section 8. what you can and can't pay for. So we're really looking forward to that. That's going to be in 2 weeks. And then 2 weeks from that, we'll be doing what we're calling our compliance sticky situations. MaxClass, as our general elective this year, we've done a chapter called Sticky Situations. These are situations that LOs have found themselves in that have basically been sticky. Maybe they should have been in trouble for them, maybe not. There are these true sticky situations. We want your questions for those sticky situations so that we can jump in here and we can address what you want to hear about. They're anonymous. You can make them anonymous or not. We're not looking to turn anyone in. It's nothing like that. This isn't a gotcha moment. We really do want to just provide value to this industry that has been so good for us. So, on that note, that's everything that I have to share. Jeana, thank you again so much for everything. And until the next one, take it to the max, everyone.
I know, LaDonna, I hope they give us a second date and they show up to our next class. That'll be a
I
lot of
hope
fun.
so. I hope so. I hope so. A date with Section 8. And let's get into RESPA. All
Have a
right.
great day,
Thanks
everyone. Thank you
again,
so much for being
everyone.
here.
We'll see you.